Joining us to take us through and make sense of all that is happening globally. James Sullivan is Managing Director, Asia Pacific Equities Research at JPMorgan, and he's joining us from the sidelines of the JPMorgan India Investor Summit. James, it's a pleasure. Great to have you with us here on the channel, on the program. As always, a pleasure is ours. So make sense to us, and I'm assuming that you will get this question from investors, etc. You meet as well, to explain this huge outperformance we are seeing, right? That word decoupling is back in vogue. How do you explain it?
First off, thanks very much for having me on the program. It's fantastic to be with you today and talking about the Indian market. To answer your question, I would approach it from two distinct directions. One, from a broader markets perspective. Two, from a microeconomic perspective. From a markets perspective, I think it's important to recognize the special place that the Indian market exists within global markets right now. It's one of the only major liquid markets where we expect GDP growth in excess of 7%. And the gap of economic growth in India relative to near-peer competitors such as China is the highest it's been on record. And so when we talk about the fact that valuation is very high, there is a reason for that. This type of economic growth is extremely scarce in global markets. You're seeing a significant investor rotation away from the very heavy index constituents in emerging markets, and in particular China, and towards not only India, but also the ASEAN markets, which are ultimately the outperformers on a year-to-date basis. So from a broader economic growth and asset allocation perspective, you're seeing very significant interest in India. And I would suggest that that's not over. You've actually seen net foreign outflows from India on a year-to-date basis, despite the near-term strength that we've seen in some of the inflows over the course of the past 30 to 60 days. So that's a very interesting backdrop. From a micro perspective, one statistic that I find fascinating, if I look at what a corporate would spend to borrow money in India, depending on the corporate, you're looking at somewhere between 12 to 14%, and overall loan growth is averaging around 11% in the Indian economy. In China right now, the average corporate would borrow somewhere between 4 to 5%, and loan growth is almost the exact same level and falling significantly. China loan growth is down roughly 30% on a year-on-year basis. India is almost doubled, despite the fact that you're spending three times as much to borrow that money. I think it speaks to the very significant interest that investors have, both public market as well as private corporates, in the Indian economy. We've obviously seen all the headlines in terms of large Indian corporates reinvesting in India in a way they haven't in close to 50 years. So there's lots of reasons to be very interested in the Indian market right now, which is one of the reasons why we think the JPMorgan Investor Summit is well-timed.
Okay. James, hi, good morning. Yeah, it couldn't have been timed better, right? Our market is very close to all-time highs. One thing which stands out is that in India, the domestic economy-facing stocks are doing the best, while the export-oriented stocks have taken a bit of a backseat, which is what had led the rally in the first place. Do you think this trend would continue?
So I do think it makes sense. If I look at the sectors that were overweight from the JPMorgan's perspective, we're overweight the financial sector on rising net interest income, as well as overall loan growth that we think will outperform the rest of the region. We're overweight the staples space. Again, the key scarcity that we're seeing in global emerging markets right now is macroeconomic growth. In India, absolutely shines from that perspective, with overall macroeconomic growth forecasted over 7%. And again, it's the relative conversation there. As China dips to closer to 3% this year, and perhaps having a 4 handle on the front of that number as we look forward into 2023, India is very differentiated. And so we do think the strength of the domestic economy is justifiably driving sector-level outperformance, particularly if the forecast is more of a global economic slowdown. At JPMorgan, we're forecasting the Fed rate to hit 4.5% next year, which is in line with the most recent Fed dots. We're expecting 75 basis points this week, as are most market participants, as are rate markets. Overall, we think central banks in developed markets will continue to have to be aggressive into 2023 in a way that's perhaps not fully priced into rate markets for longer duration bonds.
James, good morning, and good to see that you're in India. I want to ask you a little more about the Indian markets, but before that, do you reckon that the U.S. markets could retest the June lows post the Fed meeting? I ask because the data points from corporate USA is not looking too good, right? I mean, we just heard from Ford, where they have talked about how supply-side issues are causing them to see a $1 billion loss. And then a couple of days ago, you heard about FedEx closing multiple locations, delaying hiring. All of this, do you think, could drag down the U.S. markets through the course of the next few months?
So on the negative side, very clearly you're seeing pressure on corporate profitability because of rising wages, because of some of the supply side issues driving up input costs across corporate America. What I would say from a broader markets perspective that is interesting, at least for the first time this year, you've seen rates arguably fully priced in as we go into a Fed announcement, with the markets generally looking at a 75 basis point increase this time around. I don't feel as though that rate markets are fully pricing in 2023, as we had just discussed. But for this year, you're aligning expectations versus reality, perhaps in a better way than we've seen for some time. You add to that the market downturn that we've seen across a number of very large sectors, and I think we're pricing in a baseline from which we can work from. But there's still very clear significant risks, particularly on the cost side, as we enter 2023.
Just a quick point. I mean, some of the points that you made are very interesting. Asset allocation, scarcity of growth, large liquid market offering this kind of growth, etc. But does it also then risk creating an unnatural kind of a environment where money is going in because that's the only game in town and pushing things higher? And we can keep explaining it with, of course, the lack of growth elsewhere. But is it unnatural, or you think, it can go on for a long time?
It definitely creates the opportunity for valuation overreach, and that's something that we're watching very carefully. And one of our arguments, not shocking for a bottoms-up equity person to say this, but one of our arguments is that sector and stock selection is absolutely critical in this overall conversation. And I think one of the ways that we'll see investors make significant outsized returns this year is correctly understanding the sector rotation that we expect to see. To your point, you will see funds flow that is perhaps more aggressive than we've seen historically, that will find its way and potentially overinflate certain sectors. And understanding what's in the price is always important, but it's even more so in an environment like we're currently seeing, where you're seeing this very aggressive rotation of funds out of large countries in Asia and into markets like India.
James, there's one theory that I read this morning that perhaps now is time to shift from equities to bond markets, because perhaps the bond market is giving better value for money right now. Would you agree with that view?
I think the easiest way to try to quantify that is to look at the dividend yield or the earnings yield, which is the reciprocal of the price to earnings statistic, relative to bond yields that we're currently seeing. The one thing that would make me concerned on that trade is, as we've just discussed, I do believe that rate markets and bond markets still have to price in more aggressive, particularly developed market central banks as we look forward into next year. Median Fed dots are at 4.5% Fed funds rate middle of next year. Rate markets are not quite there yet. And so as we price that in, you could set the stage for a rotational trade across asset classes out of equities and into bonds. I don't think we've fully priced in the level of aggression that we're likely to see from large central banks around the world. One of the things that we're now starting to see developed market central banks respond to, and we think India will be at pace with this, with a 50 basis point increase rather than the 35 basis point rate increase that we had penciled in India, is the fact that the Fed aggressiveness is leading to very significant dollar strength globally. Emerging market central banks are going to have to respond to that. So you put all that together, and I do think there will be a time for that trade. I don't think that aggressive central bank impulse is fully priced into rate markets at this stage. Okay.
Talking a little more about India, I was going through your overweight calls, and you have a large exposure in the financial space, whether it's SBI, ICICI Bank. Of course, that space has done exceptionally well. Credit growth has picked up, especially corporate credit growth. Is this a sectoral call for you? Do you prefer financials over, say, other large caps like IT, especially in the Indian markets?
I think that's fair. And as we've discussed, despite the fact that corporates are borrowing at mid-teens interest rates in India, we're still seeing acceleration of overall loan growth and loan demand. And again, the headlines, I think, are undeniable in terms of the large Indian corporates reinvesting in India in a way we haven't seen in close to half a century. So you put all that together with the 7% plus overall GDP growth, and we see a very conducive environment for private sector investment, inclusive of large Indian corporates, which are supportive of the overall financial industry. You add to that the fact that you get a little bit more leeway in terms of pricing of debt in a rising rate environment. The impact of net interest income is quite positive. And so we do think it's right to be overweight the sector relative to other spaces in India. The other sector that we're relatively positive on is the staples space, largely because of exposure to commodities.
Financials and staples are the two overweight areas for you?
That's correct. Financials and staples, currently underweight discretionary. We are looking very closely, however, at rural income levels off the back of rising agricultural prices. The index is still up about 8 to 9% year to date, despite the recent drawdown in food prices. The JPMorgan view is that you do see structural deficit in both overall energy markets as well as food markets on a structural basis over the course of the next couple of years. And so we do think we'll see a very strong impulse for rural incomes in India as well as other regional economies, particularly across the ASEAN space.
James, I know it's a different team, the JPMorgan Index team. I put out a piece essentially kind of just highlighting the fact that there is a lot of interest and chatter around the fact that the Indian government bond market may be made part of the global bond indexes. It's a long time coming, and now finally investors are asking for it. Essentially because of some of the reasons that you highlighted, that there are Russia, for example, went out of these indices in March of this year. Any thoughts at all whether it could happen this time? I mean, the review happens and a decision usually is announced in September, early October.
As you highlighted, different team and far above my pay grade, unfortunately. What I would highlight, however, is it really touches on a very important theme for India as a country and the overall Indian equity market, which are the number of incremental steps that the government can take to really supercharge growth across the Indian economy. If it does get included, the impact on cost of funding will be meaningful, and projects that were previously uneconomic will become very, very attractive. That is a boost to economic growth. Some of the experiments that the government has put through to reduce particularly frictions for intrastate trade, I think are absolutely fascinating from a macroeconomic perspective. And so what I would suggest is overall, it touches on the idea that the government has a lot of levers yet to pull to push growth in India.
All right. Well, that seems to be the overarching theme, that India is bulletproof and continues to remain so in this challenging global environment. James, always a pleasure speaking to you, and all the best for the conference. We hope to hear from you soon on what the key takeaways were. Well, that's JPMorgan. They have an India Investor Summit underway, and very interesting takeaways coming in from there so far, at least. But let's give you some more views on the equities front. What can you expect as we head into the big global event? Chetan Seth of Nomura says higher oil prices is a risk to watch for Indian equities, while lower commodities ex-energy is a risk for crowded Indonesian equities. In general, he says low emerging market allocations and moderate foreign investor positioning provide some buffer for Asian stocks if global stocks remain soft due to policy tightening and recession concerns. Let's